That's a
All
variety.
right. So we'll get started here. I'm Owen Bondurant. I'm with a partner in Independent RX. And then so welcome to our first webinar of 2023. Last year we did do, I think, around 12 of these on varying topics with varying guests. And you know, this year we're going to start out with real estate. This is our first one of the year, and real estate is a topic we have not had on a webinar and we don't speak on often, though we do deal with it a lot. So we decided to bring in an expert, Claude Condo. He is a pharmacist, a pharmacy owner, a real estate investor, and a father and husband as well. And I'll let him introduce himself in a minute, but you know, we see this topic come up a lot on the real estate side, especially with clients who are buying and starting pharmacies. They get the opportunity to buy the building as well. Also, accounting clients come to us regular and say, hey, landlord came to me, they want to see if I want to buy the building. So you know, Claude is a client of ours, and we've known each other for a while now, so we thought it would be a good topic to talk through. So we've also got Rich and Jim from Independent RX. Rich Danhoff, he's a partner. Jim is our director of director of tax. So I don't know if you guys want to maybe introduce yourselves a bit more than that, and that'd be great. Rich.
Sure. Rich Danhoff, like Owen said, I am here at Independent RX in charge of ongoing services, which is our accounting and tax side. And I am a CPA, was with one of the big firms many years ago, and was in private industry. But for the last 15, 16 years, I've been in pharmacy, the weird business of pharmacy. And as an owner, a minority owner for most of that time. And in the last 5 years, we've kind of transitioned from ownership to helping other owners operate. And so that's where we got into the accounting and tax side. But we we come from a background of actually owning pharmacies. So
I'm Jim Sunderland. I'm a CPA. I started off in public accounting. Back then it was one of the big 8 firms, PwC. And I was there for about 10 years. And after that, I went into several different companies around the Dayton area. And in about the last 20 years of that tenure, 3 different companies, I was CFO at those companies. So got a lot of good extensive experience in finance and tax. And then about 2.5 years ago, I joined up here with IRX. So in charge of the tax side.
All right, Claude.
Yeah, sure. First of all, thank you so much for inviting me. It's a privilege. So
yeah, likewise.
Yeah, Rich and Jim. So my name is Claude Condo. I'm married. I have 2 kids, a boy and a girl. Those are my, the reason why I work hard, the reason why I love my life, right? But coming back to your question, I am a pharmacist. I'm a licensed pharmacist in Florida for the last 20 years. And one of our pharmacy has its own building. I think that will be the topic of this webinar as well. And then I used to work for the chain. And then back in 2006, I started investing in real estate. As you probably pharmacists will relate, like long hours and overwhelming. So I was looking for a passive income, something else that doesn't depend on me, trading my time against money. So that's why I stumbled at real estate. I had a coach, I got trained, and eventually I started doing residential, multifamily, and medical leases. And today we have our own company, my wife and I, it's a syndication kind of company that we take a group of investors, we go buy, retail, clinics, dialysis centers, for our investors, for us as well, as a passive income. And then we have another mentoring program, a coaching program that we take our student or investors if they want to learn more about real estate. So in a nutshell, that's who I am.
Yeah, no, that's thanks for the background, Claude. No, that's great. So I mean, you've done more real estate investing than the majority of people, right? So maybe you can give us just a bit more about why, yeah, you mentioned passive income, but maybe expand on why, you like real estate as an investment.
Man, that's a great question. I love real estate for so many reasons. One that you just mentioned about passive income, where it doesn't depend on me exchanging my time against money. The second reason was just building a financial freedom as well for my family and giving me options. I can decide to work because I love to work, not because I have to work. And then the second part is the taxes, right? The depreciation, the tax code give us so many advantages as a real estate investors, from depreciation to within even depreciation, there is cost segregations, the accelerated depreciation. I know we have tax experts here that they'll dig deeper than me, but this is just my personal experience that I've, there's other real estate professional status. So there's so many things that you can do with real estate that give me a peace of mind. And because I know how to manage my risk, I've been doing this for a while now. But you gotta know what you're doing, especially looking at the buildings, looking at the real estate, making sure that it does fit your criteria.
Yeah, that's great. So maybe could you expand on that topic, like knowing what you're doing? Because that's something that we see often is, oh, I've got a piece of real estate, I gotta buy it.
Yeah.
Right. So I mean, what are some of those tips that you would maybe the top two or what have you?
To me, I usually tell myself this, that do not be emotionally attached to a piece of real estate, right? Because when emotions it's in play, then you can make a decision it's not really a wise decision. So being emotionally detached to your piece of real estate and looking at it as a business, looking at it, is it making profit? Is not making profit? Is there any value add on this piece of real estate? What else can I do in this real estate? Can I reposition it? Maybe it was a retail. Can I make it a medical clinic? Can I bring a pharmacy there? Just looking at different angles of a piece of land or piece of real estate, so you can have different options or strategies to look at that. So
yeah, oh, that's good. Yeah, no, for sure. So I mean, you mentioned tax, you mentioned passive income. Guys, what are some other reasons that we might want to, either own real estate or own the real estate attached to our pharmacy? I don't know,
Yeah.
Rich, Jim, Claude, if you have ideas on that.
Yeah, well, I mean, I think what the majority of what we see is people get the opportunity to buy the building that their pharmacy is in, right? And maybe that's the first stepping stone into venturing out into more real estate investments. But when you look at a store, having control of that real estate, there are a lot of advantages of doing that. So it's not all just tax or financial. There are other intangibles, as well as some of the financial advantages of owning your real estate. So
I mean, one of the things too there is, I mean, you have your pharmacy and you're paying rent, and that building comes up for sale, and like, well, I can pay rent to myself here and build equity in this other entity, build equity in the building. So it's no more cost to the pharmacy. You're going to pay rent, or you're going to pay yourself if you own that entity, and you're just transferring that into that, and then you get the advantages tax wise. You're building, generating income and income to yourself, as well as building equity in those buildings all at the same time. So that's really something to look at. And we do see a lot of people, we take a look at it and say, hey, this is the rent you're paying now, but if I bought this building, then what would my mortgage be on that? What would my cash flow be on that? Take a look at it and make sure it makes sense. A lot of times we've seen where they can really reduce their rent and still build all this equity and everything. So it's a big advantage to them from that standpoint. we've also seen the other side where they have a very low rent, and what they want for the building is just exorbitant. So in those cases, it doesn't make sense. And like Claude said before, don't fall in love with that. I mean, just because it's there doesn't mean you have to buy it. And a lot of times you'll see that eventually it'll turn around where the seller or the owner, the owner of the farm of the building is going to come down in its price or be more reasonable. So sometimes it takes time for that all to mesh together. But it turns out to be a good situation for you.
Yeah.
If you don't rush into it.
And Claude, you've done this, right? You had to make this decision, right? Because you bought the building on one of your pharmacies, right?
Yes, we did. I agree with Rich and Jim, what you just mentioned, that, beside the financial, paying yourself rent versus someone else, if it makes a financial decision for you, right? If your rent is too low, then there's no point of buying a real estate. But in my case, we bought a pharmacy that had a real estate building as well. And so we bought it in a good price, right? And always that, you make money when you purchase, not when you're trying to exit. That's when you start making money. So we got it in a good price that made sense for us. And then while we bought a pharmacy, we wanted to do a working capital. So this is one of the advantages of owning your real estate, right? Because sometimes the bank doesn't know the pharmacy business, right? So they are reluctant to give a working capital to pharmacy because they don't know how, if you don't pay, how they're going to sell the prescriptions, or how they're going to sell your files or your inventory, right? So when you have a piece of real estate, to them, it's kind of like stable to them. They know if you don't pay, they can sell it. So as far as bank, in bank eyes, having a real estate actually gives you, another advantage. So in our case, we got a working capital because we had a real estate that was part of part of a pharmacy, and that was a great rate as well. So those are the advantage of owning your own piece of real estate, with your pharmacy. And the other part too is you can always do value add. Like we are bringing a urgent care in the pharmacy that we just purchased. So those are the advantage. We're gonna add our compounding section. So you can do so many things, adding value to your buildings. So that's what I was saying, that, you need to look at a piece of real estate, like, what less can I bring that is not currently, what other use can I bring to this building?
Yeah, to that point, the collateralization, the banks love collateral, right? And real estate is the best collateral. It's to Claude's point, it's far better than your inventories. It's very hard for a bank to take possession of a prescription drug inventory, your receivables. So they just don't have a lot of collateral around the actual pharmacy itself. But when there's real estate attached, you become much more attractive to the bank. And you might want to talk a little bit about, you've done so many finance deals with and without real estate, and kind of talk through the SBA and the different ways that they view real estate.
Yeah, and we're getting some questions coming in as well. So please keep asking those, because we will try to answer as many of them as we can as we go here. But yeah, on the funding side with the SBA, so when you buy a pharmacy, so most of the time we're seeing a pharmacy and the building getting bought, okay, at the same time or at separate times.
Yeah.
And when that is occurring, typically it is an SBA loan, because the majority of people who are doing it, it's a first time purchase. So there's some advantages to that. So the way the SBA works is they will fund both of them, the pharmacy and the building. The building will have a 25-year term to start. The business will have a 10. And then what they'll do is prorate both. Okay, so let's say the building is 300,000 and the business is $1 million. Well, then you might get a 12 or 13-year term for both. And what that does for you a lot of times is create cash flow, right? By moving the bigger loan out to 13 years, it reduces your monthly payment, which creates cash flow. So that's kind of how those work, and they are typically done together. And it's a really common, and back to Rich's point, is the banks love that because now they have this piece of collateral that is a real piece of collateral that they can go and sell. And like I said, it creates cash flow for you. Now, there are other ways to fund these. You know, the SBA is one, and it's very common because it's typically associated with the pharmacy. But, you know, if you're just buying the real estate, or like in Claude's case, he bought the pharmacy separately and then had real estate. Because he owned real estate, he had the ability to go get a different type of loan, right, Claude?
Yes, yes. So we got a commercial loan through our local bank. You know, that's the value as well. As a pharmacy owners, where we create relationships. So please utilize your relationship with your banks and get the best rate you can. You know, if it makes sense. Of course, each situation is different, but yeah.
And commercial conventional, you're seeing a lower interest rate, right? Because you guys, SBA right now is running. So the advantage of the SBA is you can do this combo and get a longer term on your business. Okay. The disadvantage is that you've got to pay some fees, and also the interest rates are a little bit higher. Okay. Whereas when Claude did it, he did commercial, and you saw a pretty long term with a low interest rate, correct?
Yes, yes. For this pharmacy, we got it back in March, and we got it at, I think, 4.95 with 5%. I mean, 5%, no, 5 years fixed interest and 25 years amortization, which was great. So even currently, we just purchased something in November or December that was 6.1 commercial loan. So, you know, that's a advantage for me. I mean, what I've seen for commercial loans versus SBA.
Yeah, one of the other caveats with the SBA, right, is if you're doing it with the pharmacy has to occupy 51% of the space.
Yeah, you're right, Rich. I forgot that.
So there are reasons, but again, the SBA's loans are easier to get as well because they're guaranteed 75% to the banks. So the banks are much more inclined to do an SBA loan, but it's that amortization that really drives the value, right? Because you're not going to pay. And when you buy a pharmacy and you just buy the pharmacy, it's 10-year amortization. So you're taking that $1 million purchase price and amortizing it over 10 years. When you throw in real estate, and if you got pure real estate, you're amortizing, like Claude said, 25 years. And that's spreading out the cost of that asset over 25 years is what creates the cash flow today that really makes sense. So you're paying down on the loan, you're building equity, and you're spreading it out over a long period of time. When you combine the pharmacy and the real estate, like Owen said, you're going to get a amortization somewhere longer than 10, but probably less than 25. So it just depends on the mix of how valuable the real estate is compared to, you know, the value placed on the pharmacy itself.
And that reminds me a couple things. SBA can't fund anything with residential in it. So if you've got apartments like above your pharmacy, they can't fund that. And number two, I think this is what Rich was alluding to, is that if the real estate is the largest proceeds of the loan, actually everything will go to 25 years. Your pharmacy loan, your everything. And so in that case, your you know, let's say it was a $500,000 pharmacy purchase and $1 million real estate. Well, then it flip-flops. You actually go all the way out to 25. So the 500,000 goes to 25. So I guess when it comes to funding, you know, you got to explore those options and see, you know, based on where you are today, what are your options and what fits you best to the deal, right? And it will not always be the same. Like, this isn't a cookie cutter thing. Like, oh, I just do the same thing every single time. You've got to look at the deal, the situation, and make something that's best for you. And back to Claude's point, you know, build a relationship with a banker because they can, you know, present these to you.
Yeah.
One other, to clarify what, you know, I said earlier, the 51% is actually square footage, right? So the SBA is looking that you have to occupy 51% of the square footage of the building to be eligible. But to Owen's point, if 51% of the value of the pharmacy if it exceeds 50%, then you're going straight to a 25-year amortization. So, two different calculations, but both pretty important.
And that really could cash flow when you get to 25 years for the
Yes.
whole pharmacy and the real estate. That really makes a huge difference.
Yeah.
And maybe Jim, you can answer, when you buy a pharmacy, from a tax standpoint, you have an allocation, right? You don't think about that. And,
Right.
and what the tax implications of that allocation.
Yeah, I mean, when you looked at, when you're buying that real estate, you kind of really segregate into three different pieces. You have the land, and then you've got the building. And so you want to get a good allocation between those. Of course, more to the building if you can, but then also some improvements you're making, not to the bill or that you bought that relate to the land, that you can take some pretty significant depreciation right away on. The land, unfortunately, you can't take any depreciation on that. And then the building, you can take that. Commercial real estate is going to be a 39-year life, and you do have to depreciate that over that life. It sounds like a long period, but you also have a big part of the purchase price that goes to that. So you can have that continual depreciation deduction every year. That's a non-cash item that's going to hit your income statement on the P&L. So that that's one of the things there on the depreciation, but kind of want to look at allocating that purchase price correctly. And when you can look at some of the things like a parking lot or fencing, things like that, you can take write that off under the current rules, either first year or take an 80% deduction on that. The bonus depreciation rules just changed this year.
Yep.
From the last 4 years or so, it's been 100% bonus depreciation, and now it's gone down to 80%. So if you depreciated something under those rules, you would be able to take 80% deduction up front, and the rest of that amount gets depreciated over the normal life of whatever that category is that it falls into. And a lot of this real estate, when you're making improvements after you initially buy and put the building into service, it's qualified improvement property, which falls under a 15-year, but you can take that 80% depreciation, or even better now because of the bonus depreciation decrease, taken under section 179 and get a full write-off of that as an expense in the first year. So that's some of the ones that, things that Claude was talking about earlier with, taking some big depreciation items up front. Those are some big tax advantages that you get when you do the real estate purchase.
So this is creating all kinds of questions here. So we had, going back to the loan, we had a question on, Claude, on commercial loans. What are you seeing as a down payment?
Yeah, so it depends. Banks are flexible, right? It depends on the borrower. So it depends on your relationship, how strong you are financially. So you can get, it's like my bank did, they asked me for 10% down because they knew there was a big margin. Yeah. So there was a really, we got it in a great price. But typically it's between 30 to 25% commercial, but they are flexible. And the mistake I used to make myself is I'll go to the bank and ask one bank what terms they can give me. Now I know I need to call 3 or 4 different banks and find out who can give me the best terms. So don't hesitate to call different, local banks and finding out what kind of terms they will give you. So
good advice. And on the SBA side, you guys, this was the other question that came in. We're typically at the SBA requirement is 10% of the total loan amount. So Claude was talking about working capital and so forth. So if your real estate's 300, the business is $1 million, you've got real estate of 300. Working capital of 300. You have a $1.6 million project. So you need to come up with 10% or 160,000 at a minimum. Now, some depending on the strength of you personally and the pharmacy and stuff, that can go up, but it will be 10%. The other question we have is structure. So often the real estate is owned by a separate entity and rented back to the pharmacy. For the SBA loan to work, does the pharmacy and real estate need to be owned by the same entity? And the answer to that is no.
yeah.
No, so when we owned pharmacies, we had when we had 16 stores, we had probably at least 5. We owned 5 of the real estate. Each one of those was set up, and Claude, you structure this the same way. You set it up in a separate LLC, and then you rent the real estate back to the pharmacy. But what happens with an SBA loan is there will be a single loan. There won't be 2 loans. There won't be one that goes to the real estate company and one that comes to the pharmacy. It all comes in a loan to the pharmacy. Then we just set up from an accounting standpoint to have the pharmacy loan the money to the real estate company to turn around and buy the real estate. And then the rent pays off that loan between the pharmacy and the real estate. So it's a little confusing, but typically what you would see is real estate is held in a separate LLC, and it stays in an LLC. We don't make S corp elections on that. It's a straight up LLC. It's
Yeah, but that's gonna be, passive income, so it won't be subject to payroll tax and everything like a regular LLC would be. So an LLC is a good structure for that.
Yeah.
and go ahead, Claude.
No, I was gonna say, just I agree with you guys. Yeah, we tend to separate both business because they're 2 different businesses.
Yeah, and you're trying to compartmentalize risk, right? So if you have a lot of value in real estate, and let's say you have a fill error in your pharmacy and your pharmacy gets sued, you want to keep the real estate value outside of the pharmacy. You don't want $1 million of real estate value sitting in your pharmacy. Now you're going to have insurance and make sure that you're protected from those types of things, and vice versa. If something happens with the real estate, you don't want to attach. So you're trying to compartmentalize liability, and that's what the lawyers would push you towards separating. Have we seen pharmacies that own the real estate within the pharmacy entity?
Yes, we have.
We have, but it's not advisable. In most cases, it's less than $1,000. Open a separate LLC and buy the real estate within the LLC.
And it could provide some more flexibility, later on. You own the pharmacy, you own the real estate. Maybe someday in the future, you're going to sell the pharmacy, but you want to hang on to the real estate. You've already got those as separate entities. So now when you sell the pharmacy, whoever buys that you've got a captive, tenant right there that's going to be renting the pharmacy or renting the building from you, and you still have that income that's going to continue to generate.
Likewise, you could have a pharmacist in your store that's working for you, and you want to give them some ownership in the pharmacy.
Yes.
Well, do you want to give them ownership to the building? Or you could have a partner, you could have multiple partners. We had multiple partners in our buildings that did not have ownership in our pharmacy. So
Good way to keep it separate.
It just allows you to have more control and flexibility of the ownership of both entities by keeping them separate.
Hey, Claude, you separate everything, right? LLCs, every building.
Yeah, I do. Every building has its own LLC. Now these days with technology, everything you can hire a company that does all your filing, right, from Secretary of State. So we own like 10 buildings in 7 different states. So it's hard to keep up, right? But we have this company that does file for us and make us compliant. Yeah. So
And another thing is question about tax. Some of the other tax advantages. Isn't real estate taxed differently compared to a business or personal?
Well, there's different levels. We talked about passive income, but there's different ways you treat that. And if there's kind of 4 different levels, if you meet certain criteria, you can kind of be deemed to be a real estate professional, and then it's all really comes through as active income. Then there's the next level down where you have material participation, and that it's still deemed to be active income. And again, each of these levels, there's certain criteria you have to meet. Then you've got just an active participant where it's passive income, but you are allowed to take losses up to a certain dollar amount if your income meets certain criteria. And then, of course, the last would just be where you're a passive participant and it's passive income to you, but in that case, it's kind of the lowest level where if you have losses, you can only offset that against passive income in the real estate. So as you're going through, you have to decide what level you want to be at, and can you meet some of the criteria to be able to get it as active income. Yeah.
So those are just to add to what Jim said, those are the advantage of being a real estate investor, because you can play with all those rules. Make sure that you check with your CPA like we have here, right? But to us, for example, to me, to be practical, right? So my wife she's a real estate professional, so she qualifies a real estate professional status, meaning that she does talk to a property management. She has to report, she has to record all the hours she has to do, right? You have to look at those taxation, but the good news is all those passive income, it will be kind of like active income now, then because she's a real estate professional, and that's huge, and that's one of the main advantage of owning real estate. Real estate, commercial real estate, yeah.
Right, because when you're at that level, then it's deemed to be active, and then if you have losses in 1 year, and they're going to be tax losses because of write-offs and things like that, your cash flow is still going to be good, but then you can actually use those losses and offset that against your other income that you've earned, and there's no limits on that. But when you're at the passive levels, you have limitations as far as if there's any losses, how much you can take.
Yeah, so if an example would be if your pharmacy is making a bunch of money and your real estate has losses, you may not be able to use those losses to offset the income tax that you're going to pay on the pharmacy side, right? So that's the passive versus active.
Right.
If both of them have profitability, there is no difference in the taxation, right? It's all going to flow through to you and be paid at your personal tax rates.
Right. There could be a little bit on payroll taxes if they're both entities are LLCs, with which under an LLC, then your income, you've got to pay payroll taxes on the income that you get, but on a real estate one, you don't.
Right.
That's deemed to be the passive income. You don't have to pay the taxes on that. But a good point you just brought up, or at least initiated me to say something about, would be that, if you've got a situation where you've got income on the pharmacy, but you've got a loss on the real estate, you control both of those.
Right.
So then you can increase the rent to have less income on the pharmacy and more on the real estate entity. And, as long as the rent's not outrageous, it's reasonable, and you've got leases to support all that, then you're going to have more income or eliminate that loss that you're not going to be able to use anyway. And then it's going to decrease the income you have on the other entity. And you're controlling both of those, so you can really adjust it to what you need it to be. Gives you a lot of control.
Yeah, there's so many flexibility, just you have to have the right expert on your corner. But there's so many options you can have.
And so going back, so we're getting more questions about financing these things and so forth. So Claude, there's a question about working capital, and they said, how many months of working capital do you figure into the note? Well, that's going to depend. And I have a follow-up question for you, Claude, because you use working capital in a number of ways. It depends on what you're buying and using it for. If you're using it for the pharmacy, what do you guys say, Rich, Jim, a month's worth of revenue-ish?
We usually look at a month's worth of your purchases and at least one
month
payroll,
just one,
for your bottom line cushion amount. So yeah, a month's worth of purchases, at least one payroll, if not two payrolls, to start to give you an area about where, because that's the majority of your spending. I mean, you do have rent, you've got some other expenses where you do have outflows of cash, but that's the majority. Your turnaround on your DSO on your third-party payments is usually about 2 weeks. So if you're getting 4 weeks worth of drug purchases and a payroll, you usually have enough cushion in there. So that's kind of the starting point for working capital on the pharmacy side. On the real estate side,
yeah, God, you leverage real estate for different types of working capital or to buy other properties and stuff, right? I mean, how are you, or you got a line of credit, right?
Yeah, I got a line of credit against the real estate building that that houses the pharmacy. And then just like Jim said and Rich, that it's a 1 month of inventory plus one payroll, right? So 2 weeks of payroll.
Now you were able to get a line of credit because you bought it at a good price, but then it was actually worth more than what you bought it at, correct?
Exactly. And this, the another advantage of owning commercial as well, is you can tap into your equity, right? Of course, you have to manage your risk. I can not emphasize this enough, right? Look at your situation, manage your risk, but you have options on your, if you have equity in a building, you can go to the bank and they'll give you a line of credit, they can give you working capital because they have a collateral that they can tap into if there's any issue. So
Yeah, no, that's great. And that's a huge advantage because getting access to cash can be important when you're running businesses, and that is advantage of having that. And again, it's a piece of hard collateral, so the banks are willing to give you more options, and things like lines of credit, you guys can be better because you may only pay on the interest for a period of time.
yeah.
And so it's a lower cost of capital. So that's good. Okay.
Credit is great because as opposed to if you get an SBA loan, you're taking the entire loan, you're paying interest, whether you're using the cash or not. So you've got cash sitting around potentially unused. With the line of credit, you draw down and you pay back, and it's interest only. And so it's much more flexible than, a straight up term loan or an SBA loan.
So I guess, Claude, since we have you on, I would say the majority of people on this call are not real estate experts and are probably nervous about being landlords. Any tips around, being a landlord? And I'm sure you could write a book on this, but I don't know if you've got, a few that they should be thinking about.
Yeah, that's a great question. To me, it's what kind of contract you have with your tenant, right? There's a couple different contracts. For us, it's always about triple net, where the tenant is responsible for insurances, taxes, repair, and we as a landlord are responsible for the roof and structure and the parking lot, right? So some people call it double net, triple net, gross. It depends on what kind of contract you have. I remember in couple years back when I started in 2006, I was doing residential, and that was a pain, right? Because they can call you anytime. But there's always an option. You can hire property management, to kind of handle those calls, to handle that stuff, so you can focus on what you're good at, right? So it's case by case again. If it's a commercial, I usually recommend you to do triple net. It's much easier, it's safer, and then and then if you have residential, then I'll suggest to get property management.
Okay, no, that's good. Because I hear that being a barrier a lot of times. Well, I don't want to manage the building. I don't want to have to do the repairs. I think that's also something you got to think about especially if you're owning the building that your pharmacy is in. If you have a triple net lease and you're on the other end, well, you're still responsible for a lot of the repairs. So you're still working on the building, whether you like it or not. And so it might be a reason to own the building because you're going to do a lot of that work.
Yeah.
But
sorry to interrupt.
Go
I
ahead.
was gonna say just, in case you have, I'm always thinking about the exit strategy as well. So if I own a building that my pharmacy is housed in, so I usually look at like, okay, if there's another investor or someone else coming and buying, they can look at my book on the real estate building. If it's clear and I'm making money, then of course they will, I'll charge them more. So just look at that as well as two separate businesses and making sure that your real estate is making money.
Yeah, that's a good tip. And I guess vice versa to that. I mean, when you sell the pharmacy, someone might rent from you, but also if you sell to a chain, and Rich, you've had this situation, it gives you some control, right, over what happens with the building.
Yeah, it can be a plus or a minus, right? So if you sell the business, they either move in and you get a lease, and that's a great thing. If it's file buy and you sell the files and now the building is empty, you have a challenge there. And when you do, what people don't realize is when you sell, a lot of times people don't realize is when you do sell, even if you're leasing space, if you sell files, they're going to want you to secure the building. And if you don't own the building, and that means they want to prevent another pharmacy from backfilling in your location for a period of time, usually at least 2 years. So if you don't own the building and your lease is expiring, that can be very expensive, right? You've sold your files, you've made a bunch of money, but now you've got to secure the building with the landlord, and you've got to get it in writing that they will not lease the space for a period of 2 years to another pharmacy. So it can be expensive from that side if you don't own the building. If you do own the building, you control that.
Yeah.
But now you've got to find a tenant. And so there are a lot of things to consider, around a sale, but don't assume that just because you don't own the building, there might be, we've paid, well into 6 figures to secure buildings for multiple years from pharmacies backfilling the location that we were in. So there can be costs either way.
So we spent a lot of time talking about why to buy a property, and we've only spent a short amount of time on why not. We talked about if it doesn't make financial sense, but Claude, you got any reasons why you wouldn't buy a building? Or is there more reasons why you wouldn't than why you would?
To me, that's why I talk to our students as well. It's to look at each building separately, right? Does it make sense? Is the price overpriced or not, right? And look at your criteria, so does it even make sense? Do your due diligence. Look at the taxes, property taxes. Is it, like, for example, in Miami, in Florida, taxes are way over, right? Just making sure that managing all those risks. So I'll say, like, each situation is different, but I'm always looking at the asking price. I'm always looking at, the due diligence. What value can I bring that will make sense? Can I bring any value that even if I buy that asking price, it will still make sense? I'll still make money. What's your goal on cash return? So all those questions that you need to ask yourself before jumping in a pharmacy. Like we said in the beginning, don't be emotionally attached to a piece of real estate. So
yeah, and I think too, one of the other intangibles or considerations, if you want to ever expand your business, if you own the property, then those improvements that you're making to the building are yours. So if you're going into compounding, or if you're putting in a sterile compounding where you're putting in a whole clean room, or if you're putting in a USP 800 compliant room and you have to put a hole through the roof, maybe the landlord won't let you if you're renting it, right? And to get the HVACs correct on the USP 800 room. So ownership does provide you flexibility from that standpoint too, as you look at your long-term plans for your business and for the space. And I would say, from our experience, probably 3 out of 4, maybe more, usually makes sense to buy the building when given the opportunity. But every once in a while, there's one that just doesn't. You've got a long-term lease already in place, your rent's really cheap, maybe there aren't a bunch of tenants, maybe it's priced high and the landlord wants a lot. So sometimes it's better to just sit back and enjoy what you've got, which is lower rent and a long-term lease. So you're not going to get pushed out of the location, and it works. So again, I would say the majority of them do make sense to buy because it pushes out the amortization. And by the time, even after you pick up the payment on the note, you pick up the insurance that you're going to cover, you pick up the property taxes that you're going to cover, and the improvements and all those, you add all those costs in, a lot of times it's still cheaper than the rent you're currently paying.
Yeah.
And that would make sense, right? Because the landlord is doing the exact same calculation. He's got to pay the property taxes and all. So he's adjusting the rent accordingly. And
he wants to make some money.
and
too.
he's making money on top of that. So that spread is what you want to make instead of paying it to the landlord, and build equity. But, I'd say on the reason potentially not to do it, and we face this, if you have, and again, I said, I think at one point we had 5 or 6 buildings, but that can tie up a lot of cash, right? If you're talking that you need to put 20+% down in cash and it's expensive real estate, well, now you're making a choice, right? it's an opportunity cost. Your opportunity, you can either own the real estate and invest in the real estate, and that may cause you to forego buying a second store or store down the road, or upgrading to upgrading your compounding lab because you use the cash to invest in the real estate. And if you get into multiple buildings, then you've got a lot of cash tied up in buildings. Now, as you build equity, you can get that cash back out. But at times it can be a use of cash. It's certainly a use of cash, and you have to decide the opportunity cost of, what else would you do with that cash that's going to get you a return, right? So it's either, yeah.
Yeah, that's good. And God, you mentioned, I mean, coming back to the cash topic, or reason not to, is do you ever see concerns where the maintenance or the repair cost of the building prevent you from being able to buy it? I mean, is there diligence stuff? Like, I don't know, you always hear people talk about foundations, right? Oh, if the foundation's ruined, don't buy it, right? Because you don't want to buy a building and then have to go put in 150,000 to fix it, right?
Yeah.
So I mean, do you go through a diligence process for that, or do you hire a contractor? What do you guys have?
So we usually go to a due diligence staff that we hire an inspection. So the inspector will come and check all those HVAC, check the roof, check all those stuff that we need to be checked, and to make sure that there's no like a deferred maintenance, right? And if there's a deferred maintenance, then we have to come back to the seller and ask for a seller carry or some type of refund at the closing. So there's a couple of different ways you can look at it, but typically we usually buy something that it's above 1985, right? So that's of course it depends. So it depends on the inspection report I'm gonna get and making sure that it makes sense. But those are the part of the due diligence that we go through, and there's like 2 pages of due diligence that we go through and make sure that it fit our criteria.
Okay, yeah, that's good. One question that they had, Claude, that came through was, if you buy commercial real estate that has a lease in place, are you able to break that lease to put in a pharmacy? Any pros or cons? I guess just in general, if you buy real estate, can you break the lease? Probably not, right?
Yeah, probably not. It depends on the contract, and the tenants are people like us. So if you have to talk to them, just communication, right? But look at the contract first. Is this contract expiring in a year? If it's expiring,
So, well, he was going well.
But there you're back.
Yeah, you paused a little bit.
apologize.
So you stopped at, if it's expiring in a year.
Yeah, if it's expiring a year, then I will probably wait and then and let the tenant leave and not renewing it. If I have to, I'm not a lawyer, but I just look at the contract, what it says, and if they're there for the next 3 years, talk to them, see there's maybe buyout or something. There's always something to give for you to receive what you want. So
yeah, that's part of that due diligence. When you're buying a property, if there are other tenants in there, you're going to want to study those contracts very carefully and make sure you understand them and what your rights are. And for good and bad, sometimes you want long-term leases because you want those tenants tied to you, and you want to make sure that those contracts transfer to you, and they don't have the right to leave just because the ownership of the building changed. So you want to do your due diligence on these things, and you want to get your inspections. I mean, Claude, do you ever see, because the financing is also heavily dependent upon appraisal, right? So that the owner the seller can ask whatever they want. And the bank's always going to require an appraisal, and it's going to have to appraise. Do you ever see that properties don't appraise?
yes, couple times, and sometimes the owner are flexible and they understand why it's not appraised, and they can go down to their prices, and sometimes just have to walk away. That's why there is value of doing your due diligence first, because you don't want to lose the amount of money that you have to hire an appraiser to go appraise an inspection report. When you do your due diligence, and you can avoid all those mistakes, right? by spending $1,000 and not closing a deal. So just make sure you do your due diligence, knowing what do I want, and then knowing like what is my goal? Is it cash on cash return? How am I gonna get out of this? Just doing your your due diligence upfront versus on the back end where you're gonna be spending money unnecessarily.
Yeah, and you mentioned cash on cash return. I mean, I've heard a lot of people just buying property for equity return. I mean, isn't that just fake money in the future? I mean, so if you're not getting a cash return, I mean, you're betting, are you not? Or am I?
No, I agree with you on that, but to me, like it's like speculation because I don't know what's gonna happen next week or next month. I don't know. So I'm always looking at the cash on cash right now. Is it something that I can live with, right? Just managing the risk. So when we look at the building, we look at cash flow. When we look at that pharmacy that had the real estate, I'm like, okay, typically in this area, the rent per square footage is this much. So the pharmacy should be paying this much. So if I bring another tenant, whether doctors or whether, expanding our compounding, then what will be the rent? So I'm looking at that, just like it's two different two different people, right? Even though I own both of them, but look at that. So just making sure that you're protected as well.
So another question is, and I don't know if you can ask this, I think this is dependent on the person, but what would be an average cash on cash return to expect from commercial real estate? Or what would you be considered something decent? Isn't that that's everyone's threshold for that is different, right?
Yeah.
I mean,
so I can only speak about our cash on average cash on cash. We usually tend to be at least to start with 10% cash on cash. Now these days with interest rate rising, it's really, really hard, but at least when we finish our value add to be at 10%. And then the rest with the rent increase every year with, the appreciation and stuff though. So that 10% will go to 12, 14, 15%. But in our portfolio, our average is about 11 to 12% cash on cash.
and I guess we should make sure everyone understands what cash on cash is. Can you explain that?
Sure. Yeah. So cash on cash means like if I buy a building that costs me $100, right? And then I put $10 as a down payment, 10%, right? So that means 10% cash on cash. That means I'm getting $10 every year. So that's 10%. So I want to make it really easier.
Yeah, no, that's good. Yeah, let's not get into $2 million buildings.
Yeah.
Claude.
It's $100.
Yeah. No, that's good. Yeah, that's really good advice. And I like the advice of separating. I mean, you have to look at the pharmacy and the building together because there are things like getting it out 25 years, but thinking of them as two different businesses is good advice because you can go back to what Rich said. It does eat up more cash, right? If you buy that pharmacy for $1 million, you only have to put in 100,000. You add the building on, suddenly we're at 130,000. So we've eaten up 30,000 more. So some of that could relate back to your goals and, what kind of investments are you making and what's your return on that? So understanding the return on the businesses individually is really good advice. Okay.
I think, one other thing that as you talk about rising interest rates and the challenges there, and, we're feeling it, in lots of ways with inflation right now. But, one of the encouraging signs, if you do have an opportunity to buy, the banks are recognizing that, this is causing some challenges. And we've recently seen one of the big national commercial or SBA lenders come out with some interesting terms, right? I think they were capping it at 8% for 5 years and then flipping it to, which is lower than what you would get on the pharmacy right now. Typically the pharmacy is prime plus 2 points. And I think prime is at 7.75. So prime plus 2 on the pharmacy, this is capped at 8 and it has no upward mobility, but it has downward. If the rates come down, they'll bring it down. So they're trying to make it, again, that just shows the bank's interest in you doing real estate, right? So they're making creative products and trying to help you. They like the real estate as collateral. So they've got some unique lending, and that, Claude, you talked about that earlier, work with your bank to figure out what they can do, because they'll have flexibility. And especially if you've got good credit, you've got a healthy store, got an opportunity to buy a building, you got an opportunity to buy a store and a building together. There's a lot of different ways that these can be financed and protect you against long-term inflation and get these things financed at a reasonable rate, even in today's environment.
Yeah.
And
If I
seller
don't,
financing is always an option as well.
exactly. Yeah. Just being creative, the creative financing part, that's a huge part of this world of rising interest, right? Because you can go back to the seller and kind of structure a deal as well as a seller financing. So we've seen that a lot actually in this market. So
Yeah, and that's a lot of it, you guys. It's kind of figured out what the cash flow is of the pharmacy, the building, if you're just buying a building on its own, and then seeing if you can get financing that will allow you to keep all that cash.
yes.
Because if you can't, going back to what you said, Claude, don't be emotional, walk away. Because some of the best investments we've seen are people who didn't make them.
Yeah.
So I think that's a good parting word. Anything else? Words of advice from anyone?
I'll just, my advice would be just to kind of have a vision and goals and, reach out. That's why we are here. Reach out to Owen, Rich, Jim, or me for any question that you might have, right? We are here to serve you guys.
Yeah. And so on that, Claude, how do people reach you?
So I'm active on LinkedIn, and then or in our website, rxrei.com. They can send a request and, me or one of our team members will reach out.
Great. Yeah. And I know all the team members there, they're great. They do know what they're talking about here. And on our side, all of us are on LinkedIn. Our website's independentrxconsulting.com. Reach out if you have questions. And thanks everyone for time. Thank you, Claude. Appreciate you spending time with all your travels.
It was fun for sure.
Yeah, real good. All right. Thanks everyone. See you.
Thanks.
Bye.